Markets have always been driven by a complex interplay of facts, forecasts, and, perhaps most of all, emotions. In times of uncertainty, whether triggered by geopolitical tensions, shifting inflation data, central bank decisions, elections, or unexpected events like pandemics or financial crises, volatility tends to surge. Prices can swing wildly from one day to the next, and the news cycle becomes a relentless drumbeat of speculation and anxiety. For investors, these periods can be deeply unsettling. Yet, history shows that how you respond to uncertainty can make a profound difference to your long-term investment success. When the headlines scream of market turmoil, the first and most important step is to stay calm. It's natural to feel anxious when you see your portfolio's value fluctuating, sometimes dramatically, in a matter of days or even hours. But panic selling, dumping your investments in a knee-jerk reaction to negative news, almost always leads to poor outcomes. Volatility is an inherent part of investing. Markets go through cycles of ups and downs, and overreacting to short-term noise can lock in losses and prevent you from benefiting when the inevitable recovery arrives. Take a deep breath, step back, and remind yourself that you're in this for the long haul. This is a good time to revisit your investment plan. Ask yourself, what are my goals? Am I investing for retirement, a child's education, or another purpose that's years or even decades away? If your investment horizon is 5, 10, or more years, then today's uncertainty, no matter how intense, shouldn't derail your strategy. Instead, use this moment as an opportunity to review your asset allocation. Does your mix of stocks, bonds, and other assets still align with your risk tolerance and time horizon? If not, consider rebalancing your portfolio to bring it back in line with your original goals. Another crucial step is to ensure you have a solid cash buffer. Life is unpredictable, and having an emergency fund, typically 3 to 6 months' worth of living expenses, set aside outside your investment accounts is essential. This safety net allows you to cover unexpected expenses or ride out a downturn without having to sell investments at a loss. If you're feeling uneasy about the current environment, it might make sense to hold a bit more cash than usual. Not only does this provide peace of mind, but it also gives you the flexibility to take advantage of opportunities that arise when markets are down. Diversification is your best defense against uncertainty. By spreading your investments across different sectors, geographies, and asset classes, such as stocks, bonds, gold, and real estate, you reduce your exposure to any single risk. While diversification doesn't guarantee you won't experience losses, it can soften the blow when one area of the market is hit hard. Think of it as building a resilient portfolio that can weather a variety of storms. In turbulent times, it's especially important to focus on quality. Look for investments in companies with strong balance sheets, stable cash flows, and resilient business models. These are the businesses that are better positioned to withstand economic shocks and emerge stronger on the other side. While riskier, speculative investments may offer the allure of quick gains, they're also more vulnerable when uncertainty strikes. Quality tends to outperform when the going gets tough. Consider defensive plays for added stability. Certain sectors, like consumer staples, healthcare, and utilities, tend to be more resilient during downturns. These are the companies that provide essential goods and services, regardless of the economic climate. Dividend-paying stocks can also offer a measure of stability, as they often generate steady income even when share prices are volatile. Rather than fearing volatility, savvy investors use it to their advantage. One proven strategy is dollar-cost averaging, investing a fixed amount at regular intervals, no matter what the market is doing. This approach takes the emotion out of investing and can help smooth out the impact of short-term price swings. When markets dip, your fixed investment buys more shares. When markets rise, it buys fewer. Over time, this can lower your average cost per share and reduce the risk of making poorly timed lump sum investments. Market corrections, while unsettling, can also present opportunities to buy quality assets at a discount. If you have a watch list of companies or funds you believe in for the long term, consider adding to your positions when prices fall. Just be sure to stick to your plan and avoid chasing speculative bets in the hope of a quick rebound. In the age of 24/7 news and social media, staying informed is important, but so is filtering out the noise. It's easy to become overwhelmed by a constant barrage of headlines, many of which are designed to provoke fear or excitement rather than provide actionable information. Focus on the facts: economic indicators, central bank signals, and company fundamentals. Tune out the sensationalism and avoid making decisions based on rumor or emotion. One of the most enduring truths in investing is that time in the market beats timing the market. Trying to guess the perfect moment to buy or sell is nearly impossible, even for seasoned professionals. Markets are unpredictable, and missing just a few of the best days can have a significant impact on your long-term returns. History shows that investors who stay the course, riding out the ups and downs, tend to fare much better than those who jump in and out in an attempt to outsmart the market. It's also worth remembering that uncertainty is, paradoxically, a constant in investing. There will always be reasons to worry: trade wars, elections, interest rate hikes, technological disruptions, and more. Yet over the long term, markets have shown a remarkable ability to recover and grow. The key is to keep your focus on your goals, stick to your plan, and trust in the power of compounding. If you find yourself struggling with anxiety during volatile periods, it can help to limit how often you check your portfolio. Constantly monitoring your investments can amplify your emotional response and increase the temptation to make rash decisions. Instead, set a regular schedule for reviewing your accounts, perhaps once a month or quarter, and use that time to make thoughtful, deliberate adjustments if needed. For those nearing retirement or with shorter time horizons, it's especially important to assess your risk exposure. Consider gradually shifting a portion of your portfolio into more conservative assets, such as bonds or cash equivalents, to reduce the impact of market swings. This can provide greater peace of mind and ensure you have the funds you need when you need them. Finally, don't hesitate to seek professional advice if you're unsure how to navigate uncertain times. A trusted financial advisor can help you clarify your goals, assess your risk tolerance, and develop a strategy that's tailored to your unique situation. They can also provide a valuable sounding board, helping you avoid the common pitfalls of emotional investing. In summary, uncertainty is an unavoidable part of investing, but it doesn't have to derail your financial journey. By staying calm, sticking to your plan, maintaining a cash buffer, diversifying your portfolio, focusing on quality, considering defensive plays, using volatility to your advantage, filtering the noise, and prioritizing time in the market. Overtiming the market, you can not only weather the storm, but emerge stronger on the other side. Remember, successful investing is less about reacting to every twist and turn and more about having the discipline and perspective to stay the course when others are losing their way. The most rewarding journeys are rarely the smoothest, but with patience and resilience, you can reach your destination.